over 85% of professional fund managers fail to beat the market over 10 years. Think about that. These are people with teams, data, and millions of dollars at their disposal. And yet a simple ETF often outperforms them. Now here's the twist. While ETFs quietly crush most pros, individual stocks can still make millionaires overnight. One right pick, Amazon in 2001, Apple in 2003, Nvidia in 2015, could have changed your entire financial future. So the question isn't just what's safer, it's which actually builds wealth faster for you. In this video, we're breaking down ETFs versus stocks in a way that's real, relatable, and practical. No jargon, no fluff. Just the truth about how everyday investors, people juggling jobs, families, and bills, can use these tools to build lasting wealth. Stick around because the answer might surprise you. Let's start with ETFs. An ETF, or exchange-traded fund, is like a basket of investments. Instead of buying one company, you buy a slice of hundreds. Imagine walking into a grocery store. You could buy one apple, or you could buy a fruit basket with apples, bananas, oranges, and grapes. That basket is your ETF. Why does this matter? Diversification. With one purchase that you spread your risk across dozens or even hundreds of companies. If one company tanks, the others balance it out. That's why ETFs are often called the set it and forget it investment. Now, here's the kicker. ETFs don't just protect you from risk, they also give you access to entire markets. Want exposure to tech? There's an ETF for that. Want healthcare, real estate, or even clean energy? ETFs make it simple. And fees? They're usually lower than mutual funds. That means more of your money stays invested, compounding over time. But let's be real. ETFs aren't exciting. You won't wake up to a headline saying your ETF doubled overnight. They grow steadily, quietly, almost boringly. But boring can be powerful. Over 20 years, the S&P 500 ETF has delivered average annual returns of around 10%. That's enough to double your money every 7 years. Think about that. If you invested $10,000 in an ETF tracking the S&P 500 20 years ago, you'd have over $65,000 today. No stress, no sleepless nights, no guessing which stock will pop. So ETFs are like the reliable friend. They won't wow you with flashy moves, but they'll show up consistently year after year. And for most busy adults, people working jobs, raising families, dealing with life, that reliability is priceless. But here's the cliffhanger. While ETFs are steady, stocks can be explosive. And that's where things get interesting. Stocks are ownership. When you buy a stock, you're literally buying a piece of a company. That's powerful. You're not just holding paper, you're holding a claim on profits, growth, and the future of that business. And here's why people love stocks. They can change lives fast. Imagine buying Amazon in 2001 when it was under $10. Today, it's worth thousands. That's the kind of growth that builds wealth faster than almost anything else. But here's the dark side. Stocks are risky. Companies fail. Markets crash. One bad earnings report, one scandal, one shift in consumer behavior, and your investment can plummet overnight. Stocks are emotional. You'll check your phone constantly. You'll feel the highs when your stock jumps 20% in a week. You'll feel the gut punch when it drops 30% in a day. And that emotional roller coaster can lead to bad decisions. Selling too early, buying too late, chasing hype. Here's a relatable example. You're working a stressful job. You finally save $5,000 and you put it all into one stock you believe in. At first, it climbs. You're excited. You start dreaming about quitting your job. Then suddenly, the company misses earnings, the stock tanks, and half your savings vanish. That's the reality of single stock investing. But stocks also give you control. You can choose companies you believe in. You can align your investments with your values, clean energy, tech innovation, healthcare breakthroughs. And if you pick right, the upside is massive. So stocks are like high-risk, high-reward bets. They can build wealth faster, but they can also destroy it faster. And that's why the debate between ETFs and stocks is so important. Because it's not just about returns, like it's about your lifestyle, your stress level, and your ability to stay consistent. Now let's put them head to head. All right, let's compare directly. ETFs, diversified, lower risk, steady compounding, lower fees, less emotional stress. Stocks, concentrated, higher risk, potentially explosive growth, requires research, emotionally draining. So, which builds wealth faster? The truth is, it depends. If you pick the right stock, nothing beats it. One Apple, one Tesla, one Nvidia. Those can multiply your money in ways ETFs never will. But the odds of consistently picking winners are slim. Even professionals fail most of the time. ETFs, on the other hand, may not double overnight, but they compound steadily. Over decades, they quietly outperform most stock pickers, and compounding is the real secret to wealth. Here's the cliffhanger. The fastest way to wealth isn't about choosing ETFs or stocks. It's about staying invested long enough for compounding to work, and that's where most people fail. They panic, they sell, they chase hype. So the real winner, the strategy you can stick with. Let's get practical. You're 30, 40, maybe 50. You've got responsibilities, a job, maybe kids, bills, stress. You don't have time to gamble on stocks all day. Here's a simple framework, core and ETFs. Put 70 to 80% of your money in broad ETFs like the S&P 500. This gives you stability, diversification, and long-term growth. Satellite and stocks. Use 20 to 30% for individual stocks you believe in. This scratches the itch for excitement and gives you upside potential. Automate. Set up monthly contributions. Don't rely on willpower. Check emotions. If you're losing sleep over a stock, it's not worth it. Think decades. Wealth builds over time. Compounding is boring until it's life-changing. Relatable example. Imagine you're 45, saving for retirement. You put $500 a month into an ETF. Over 20 years, that grows to hundreds of thousands. Add a few smart stock picks along the way, and you could accelerate that growth. This balanced approach gives you the best of both worlds. Stability and excitement, safety and upside. And most importantly, it keeps you consistent, because consistency beats brilliance in investing. So, ETFs versus stocks. Which builds wealth faster? Stocks can give you speed. ETFs give you consistency. But the real winner is the strategy you can stick with. Here's the truth. Wealth isn't built in weeks. It's built in years. Decades, through compounding, discipline, and patience. So try this today. Open an ETF account. Buy one ETF that tracks the market. If you want excitement, add one stock you believe in. Watch how it feels. You'll learn quickly whether you're comfortable with the roller coaster of stocks or the steady train of ETFs. And remember, the goal isn't just money, it's freedom. Freedom from stress, freedom from paycheck to paycheck living, freedom to live life on your terms. So let's level up together. Start small, stay consistent, and let compounding do its magic. Because the fastest way to wealth isn't chasing the next hot stock. It's building a strategy you can actually stick with